So the problem statement that I was trying to solve with my research is to enable the use of actuarial models in modeling broader customer behaviors, such as long-term profitability, customer retention, sales funnel conversion, price sensitivity, etc. In today's actuarial pricing and predictive models, a typical observation only looks at the 1 year or short-term profitability or loss experience of a customer. And the problem that I was trying to solve was how can we use actuarial modeling to model the long-term profitability or the long-term loss experience, and how can that be used to identify actuarially favorable segments and lower complexity segments of business. So an example that I have mentioned here, this is specific to the property and casualty industry. I've used an auto example that the 1 year loss ratio of drivers with speeding tickets might be found to be 40% higher than average, and they might be priced accordingly. But when we look at the 3-year loss ratio of those same customer segment, which is drivers with speeding tickets, that may only be 15% higher than the average. And so the goal here is how can we use actuarial modeling to identify these differences in risk and price for the longer term behavior of customers rather than focusing just on the shorter term. Because what commonly happens is, with the same example of drivers with speeding tickets, if me as a driver, I have a speeding ticket, my premium might jump up by 40% for the next year. And so I might start shopping around for finding lower insurance premiums. Whereas in reality, my long-term experience averaged out across, let's say, 5 or 10 years that I'm going to be with an insurance company might actually not be that high. And so what can insurance companies do to find profitable segments within customers that have relatively higher risk, but still be able to retain them over the long term? So this is a small visual of the suite of actuarial models that I have researched that help model these customer behavior. It starts with modeling risk complexity or variability, customer retention probability, future customer growth, and their long-term profitability. So let's start with risk complexity. Risk complexity can be defined as the variability around the predicted loss experience of a risk. It can be modeled using Bayesian models, which are still relatively new in the actuarial world, but Bayesian models typically use Monte Carlo Markov chain techniques to fit models to hundreds and thousands of randomized subsamples of the data. And as a result, instead of getting just a mean set of coefficients or mean predicted outputs, you can actually predict the range of outputs from the same model. And when the model predicts a wide range of loss costs or loss ratios for the particular risk, that can be interpreted as the model having less confidence in the ability to predict the risk for a customer versus for models with lower complexity, the model is able to predict the risk of a customer with higher confidence. This is represented visually in the diagram from some models that I have developed. So in the leftmost corner, you can see what a low-risk customer would look like in terms of their predicted loss cost over a period of time, versus as you go from left to right, the higher risk customers, where higher risk is basically higher variability around the predicted risk. So to use an example, the predicted mean risk for a high risk and very high risk customer may be similar in terms of the mean prediction, but the variability for the very high risk customer could be much more because the model has fewer data points or lesser confidence in the ability to model that risk compared to, let's say, a high or medium risk customer. This helps the actuarial model to identify customer segments where the model has greater pricing confidence, and therefore the low-risk customers can be triaged to underwriters to basically let them know that these are the customer segments which we can target more and favorably price or price using better credits. The second model in the suite of models is a model to predict the retention probability. Modeling the retention probability helps an insurance company identify how long could we expect to have this particular segment of customers, and therefore be able to identify the overall average profitability or loss experience of a customer across that overall time segment. So for example, if an insurance company finds a customer segment where the average duration might be only 2.5 years versus a different customer segment where the average duration would be 5 years, it is more likely that they would be able to increase the profitability of a customer which is likely to stay with them over 5 years because their loss experience would get averaged out. And so going back to the same example of people with driving tickets, even if the 1-year loss experience of a customer with a driving ticket might be higher than average, if an insurance company is going to have the customer for 5 years, their loss experience averaged out over 5 years might be much lower. And so instead of having a higher rate increase for those drivers with speeding tickets, there is an opportunity to segment the drivers with speeding tickets into low or high retention groups and price them accordingly. One of the important variables that helps make this model more accurate is using rate change and interacting the rate change with different customer segments, which allows us to find how different customer segments interact with rate change. So for example, in my research, I found that the average retention of drivers with speeding tickets may be equal to 80% when the rate increase is lower in the range of 10%. But that same retention may drop much lower to 75% when the average rate increase is higher for 15%. And it reflects the competitive market because other insurance companies might be trying to go after the same customer and maybe pricing more favorably compared to your insurance company. So this is a visual diagram, and this represents only a univariate chart of how the rate change interacts with the churn relativity. But in reality, a machine learning model is used to model the interactions between all the different customer segments and their reaction to rate change. A third piece of this puzzle is modeling future customer growth. This model is a classification model. It uses historical customer policy data to identify customer segments where there is room for future growth, not just from a specific line of business, but also from different lines of business. Some of this growth may be driven by adding household members to the policy, or adding new cars to the policy, or adding increases or decreases in vehicle value. Because this is it is a complex model to develop linearly, because there are several interacting factors that drive the future premiums. So that is why I segmented the target variable into a low, medium, or high category based on the 5-year premium growth at a customer level. So this way, we are looking at a customer not just at a point in time, but rather we are looking at a customer longitudinally throughout their duration with a with an insurance company to see how a customer's overall lifetime value grows with the insurance company. This allows us to, again, model the longer time customer behavior because today a customer may just have one policy with you, and it may be, for example, an auto policy for just one car, but through their lifetime, they may get married, they may have children, they may add those children to their policies, they may buy new cars, they may buy a home, and or they may buy pets, they may buy travel insurance. And so the ability to model out that future customer premium growth may be very well key to retaining higher long-term value customers and not losing them out because of short-term pricing changes or rate increases. This is just a visual representation of some of the key drivers that I found which drive the customer growth. So from additional vehicles or added drivers, from added coverages or services. For example, today a customer might have a liability-only policy, but tomorrow they may add more coverages for their vehicle or for their home. Growth from additional policies such as home insurance, pet insurance, and growth from added family members, referrals, etc. We come to the final piece of the puzzle before we tie it all up into how it affects customer lifetime value. So the long-term profitability, for modeling that, I tried to model that by training a generalized linear model using the 3-year loss cost as the target variable. So this involved stitching the customer data across time, both with respect to the exposures as well as the losses, and then training the model using that 3-year data as one observation in the model. Using that, we find some very interesting interactions and impacts on their long-term profitability. I'll actually go on to show some of these points visually. So the red line over here in the chart that you can see is the 1-year loss cost curve. This variable is for speeding violations over the last 3 years. When we look at the 3-year loss cost for this same variable, we see that it is a much flatter line, meaning that over the long term, people with 1, 2, or more speeding violations may not actually have such an outsized impact on the loss ratio. However, in today's pricing models, most of the modeling is done similar to the red line, where high rate increases are imposed on people with speeding violations. A very similar example is with vehicle age, where newer cars they tend to be over-penalized because their 1-year loss costs tend to be typically higher compared to older cars. And it makes sense because of rising severity arising from vehicle and repair cost inflation. However, when we look at the same curve with a 3-year loss cost and a longer-term view, we see that there is still a sharp curve, but it is not as sharp as what typically today's pricing models account for. So what does this mean for the overall customer lifetime value? We saw that there are several techniques to model out the long-term customer behavior in terms of their retention probability, in terms of their future premium growth, and in terms of their long-term profitability. And this, the customer lifetime value is just one way to tie these model outputs together and not necessarily use directly in the model to price, but also potentially to segment customers into low, medium, or high customer lifetime value buckets, because that way it allows the information from the actuarial model to be permeated across the organization, to be used in marketing strategies and or underwriting strategies. The formula that I used for the customer lifetime value was the premium, like today's premium times the duration, the expected duration for the customer, times the future growth expectation from that customer, averaged out across a customer segment, times the profitability, which is 1 minus the long-term loss ratio. This is a visual example of how the customer segments, often once we bucket the customers into their low, medium, or high customer lifetime value, it can be combined and with the risk complexity model to find almost a matrix between risk complexity and customer lifetime value. So our most favorable customer segments are the ones where we expect higher customer lifetime value, and they have low to medium risk complexity, because it basically means that with a fair degree of certainty, the models are telling us that over the long term, these customers are going to be the most profitable for an insurance company. And on the other end of the spectrum are customers or customer segments where the risk complexity is high. The customer lifetime value may still be medium, but there is more uncertainty with respect to the ability of our actuarial models to predict their customer lifetime value. Some of the benefits of the customer 360 modeling is, first and foremost, it allows the use of actuarial models beyond just the traditional pricing and reserving use cases. It allows the use of actuarial models for modeling customer behaviors, and in turn be used for new business targeting, where marketing efforts and agent conversion techniques can be focused more on segments which are more likely to bring in favorable business. So the ability to identify those customers with higher lifetime value and market or price those segments accordingly. It can also be used in targeted marketing messages during the quote to conversion journey, because typically in today's world for direct selling of insurance, everyone sees the same sort of messaging when they are quoting. So if I go online and try to find a quote for let's say an auto insurance or a home insurance, I'm seeing the same messaging that millions of other customers are seeing. But what can the insurance company know about my specific risk, complexity, and variability that can be used to target the messaging? So maybe I could be seeing a better deal because I am a low risk due to X, Y, or Z factors. How can insurance companies use that information to make specific quote messaging for me as a high value customer? Similarly, these models can be used for identifying segments with higher probability of cross-selling or upselling, where the insurance company can identify customer segments who are likely to grow their business with the insurance company over time. It can also be used to automate the underwriting processes for lower complexity customer segments where we have a high degree of confidence in the pricing models, and also prioritize underwriting efforts for higher complexity but higher customer lifetime value business segments. And finally, for actuarial pricing and rating algorithms, there's a large opportunity to improve the pricing and rating algorithms that reflect not just the short-term customer loss experience, but reflect the longer-term customer profitability, which can help increase the conversion or retention rates in actuarially favorable customer segments. That's it for my presentation.
Thank you, Satraajeet. And I see the questions have started to come in. So if you address one of or two of these, and then we can take the rest at the end. So I have a couple of these that really speak to me. Like one is, how would you quantify the future value of a policyholder requiring further cover? For example, getting married, having children, and adding them into a policy. This seems difficult to project and difficult to obtain a complete training data set for.
Yes, this is definitely one of the challenges that I faced. The key to modeling this out was, for my data set was to not try and model exactly the, let's say, the probability of someone getting married. That is something that is very difficult to model out, or the probability of someone having children. But what we can model out by looking at customer or policy data is by looking at the target variable as the percentage of growth from year 1 that they joined to year 3 or year 5 when they have been with the insurance company. When we look at just the premium growth as a target variable, it allows us to identify customer segments which are likely to fall into a low, high, or medium category without needing to specifically model whether the future premium growth comes from additional policies or additional children. It just allows us to see, so for example, I found that customers with medium to high credit score have a higher probability of growing their business with an insurance company over time. So that was the key that I used, which was not to necessarily try and model this linearly or model those based on an exact set of drivers, but rather to use a classification model to segment customers into low, medium, or high growth.
Okay. You spoke, and this is not a question I found inside, but it's a follow-up. You spoke about longitudinal data. Have you tried using the shared data from the European Commission on that?
I cannot say that I have.
Okay. It follows population every 3 years, so it might be an idea for you. So I'm going back to, there are a lot of questions actually about the customer lifetime value. I'm going to give you one more, and then we'll go to the next presentation and come back at the end, because I see there's a lot of interest in this. So customer LTV has been talked about for some time now. However, given the strategy is inherently long-term, do you see insurers having appetite to deploy LTV strategies when the focus is usually short-term targets?
So for a long time, I can speak at least to the US market because that's where I've seen most of this. For a long time, yes, the focus used to be just on the short term because that is the inherent nature of property and casualty business. What some of the leading insurers are now pivoting towards is they've seen the success that a lot of smaller insurance companies such as farm bureaus or state funds in the US have, where their customer retention is typically as high as 90 to 95%, whereas a typical non-mutual for-profit insurance company only sees about 70 to 75% retention. And with the increasing loss ratios and some of the customer behaviors that the major private insurers were seeing, they started to pivot to using interaction terms to try and model out customer lifetime value. I remember in my days as a consulting, actually reading about how Geico used customer lifetime value, not necessarily directly in their pricing models, because in the US, the rating algorithms are publicly filed, and so Geico would have to give away their secret sauce. But instead, what they did was they built out these massive rate filing tables, which are literally 1,000 pages long. But what they are actually doing is they are building in factors that are proxies for customer lifetime value. And an example of this actually is very personal to me. So I recently moved from New York to California with my wife, and our insurance premium almost immediately went up by almost 50%, just because we were moving from one state to another. And so when we tried to quote with Geico, that is when we saw that our insurance premium was almost 50% lower than what Progressive, which was the previous company, had quoted with us. And this was a live example of how I could see Geico using customer lifetime value in action by trying to target us as a potential longer-term customer.
Okay, thank you very much.